Welcome to the Deep Dive. Today we are focusing laser-like attention on LifeVantage Corporation, that's LFVN, and we're cutting through the noise of their Q1 fiscal year 2026 earnings call.
And this was a really pivotal call. You saw that volatility right away. It was a classic tale of two reports, really. A nice little surprise on the bottom line.
But a big miss on the top line.
A very noticeable miss. So our mission is to unpack that, but more importantly, to dig into management's really aggressive pivot and figure out why the market is just so skeptical right now.
Okay, let's start with that mixed bag then. Let's hit the disappointment first. Revenue, what was the top line story?
Yeah, that was the clear pain point. Q1 revenue came in at what, $47.6 million?
Which is basically flat, minimal growth, just 0.7% year over year.
Exactly. And that number was significantly softer than what analysts were expecting. I mean, consensus was looking for something comfortably in the mid-50s.
So a nearly 10% miss, that's big enough to overshadow pretty much everything else.
It really is.
All right, revenue miss noted. Let's shift to the bottom line, because that's where they managed to pull out a small win.
They did, yeah. Their expense management was pretty solid. They delivered adjusted non-GAAP EPS of 18 cents.
And just for you, the listener, that non-GAAP number is key. It strips out certain one-off items, probably some costs tied to their new acquisitions, so you get a cleaner look at the core business.
Right. And that 18 cents just edged out the 17-cent consensus forecast. So small beat, but a beat nonetheless.
That's the good news. But I saw some challenging news on the efficiency side. Profitability was under pressure.
It was, yeah. Adjusted EBITDA fell to $3.9 million. That's an 8.2% margin, which is down quite a bit from the 9.4% they posted a year ago.
So where did that margin compression come from?
It was mainly two things. First, higher operational costs.
Yeah.
So think shipping and warehouse expenses. And second, increased commissions and incentives.
So they're spending more to move the product and more to motivate their salespeople.
That's the story. That pressure on commissions is a really interesting signal in this direct sales model.
Okay, and what about the balance sheet, the financial health?
It's strong. They're still debt-free. They have about $13.1 million in cash. But, and this is a big but,
The cash flow?
the cash flow. Q1 operating cash flow was negative $2.3 million. That's a bit of a red flag.
So is that just temporary, like working capital churn, or does it tell us that the integration costs for their new acquisition were maybe heavier than they let on?
Management would definitely argue it's temporary, investment ahead of the big pivot. But it's a point of tension for sure. It suggests that even with that clean EPS number, they were burning real cash to set the stage.
And despite that cash burn, they're still returning capital to shareholders.
Oh yeah, they declared another dividend, 4.5 cents per share. Since the start of fiscal 24, they've returned almost $20 million.
Okay, let's pivot sharply then. Because this whole call felt like a sales pitch for the future, not a review of the past. The CEO called Q1 pivotal, but we have to remember a critical fact here.
A very critical fact. The LoveBiome acquisition closed on October 2nd.
Meaning it contributed zero revenue, not a single dollar to the Q1 results we're talking about.
Exactly. The results were backward-looking, but management's focus was entirely forward. They spent the quarter getting the systems ready, and they really wanted to stress that the heavy lifting is already done.
How done are we talking?
They're saying fully done. By November 1st, LoveBiome's entire infrastructure, e-commerce, back office, the whole compensation structure was cut over to the LifeVantage platform.
That seems remarkably fast, maybe too fast. Does that kind of speed worry you, especially when you're merging complex compensation plans for a sales force?
It is the $47 million question, isn't it? Management insists the big plumbing risk is behind them. They're saying the focus now is all on commercial execution.
And the rationale for this deal is to get into the gut microbiome space, right?
Right. They want to be at this intersection of natural GLP-1 activation, that's their existing business, and this massive high-growth gut health market.
How big is that market they're chasing?
It's enormous. The projections show the gut health supplement market more than doubling over the next decade. We're talking from around $14 billion today to over $32 billion by 2035.
And their entry point is LoveBiome's flagship product, P84.
P84, yeah. It gives them an immediate, and they would argue, a scientifically differentiated product to go after that massive prize.
Okay, differentiated is a key word. What's the science they're claiming gives them an edge? What is this activation ecosystem?
They're really leaning into new data. They have new in vitro testing on P84 that shows it activated, I think, 14 natural peptides that are all associated with gut health regulating, repairing, restoring.
So it fits their whole philosophy. The products don't just supplement, they activate the body to do its own work.
Precisely. And it ties right into their existing MindBody GLP-1 system. The whole Q2 strategy is about pairing these two platforms.
The healthy edge stack, they're calling it.
The healthy edge stack, yeah. Combining their established Protandim NRF2 product with this new P84, they think this synergy will create this peak performance wellness system.
So if we're using an analogy, Q1 was like the messy kitchen renovation. We just got the bill, but none of the new appliances have cooked a single meal yet.
That's a perfect way to put it.
So let's get back to that Q1 bill. How did management explain away the softness?
They had a few reasons.
Yeah.
First, seasonality. Q1 is historically their weakest quarter, consultant inactivity over the summer.
Okay, fair.
Second, they had a tough comparison against last year when they had that big promotional launch for the MindBody system.
And the third reason, this one felt very specific to their business model.
It was. They basically admitted that some of their own consultants kind of paused their activity. They were waiting to get clarity on the LoveBiome integration and the new products before they went back to selling hard.
That pause is lost momentum, and it came at a terrible time. But here's the craziest part for me. Despite that miss, management reiterated their full-year guidance.
Fully reiterated. Revenue of $225 to $240 million and adjusted EPS of $1 to $1.15.
Which implies a massive, almost unprecedented ramp-up in the next 3 quarters.
It requires a massive acceleration. The guidance is hugely back half weighted. They are betting everything on 2 giant tailwinds.
Let me guess. One is mind-body seasonality.
Right. The traditional weight loss demand that spikes around New Year's and then again before summer. And the second is the full contribution from LoveBiome. They're counting on successful cross-selling to really ramp things up.
This brings us to the investor context. The stock looks cheap on paper, right? Trading at, 8 or 9 times earnings, less than half of sales, high ROE. But it's sitting near its 12-month low. Why is the market ignoring these metrics?
Because the market's behavior is just screaming deep, deep skepticism about execution. Investors are essentially betting that the structural headwinds of the direct selling industry are going to swamp any of the science behind P84 and MindBody.
Let's define that for the listener. When we say structural headwinds, what are we actually talking about?
We're talking about the challenges baked into the multi-level marketing model itself. That constant churn, the struggle to recruit and keep good consultants, the difficulty of scaling a person-to-person sales model when e-commerce is dominant.
So the market thinks even with great products, the business model itself is just too fragile.
That's the bet. And you can see the most aggressive signal of that skepticism in one place.
The short interest.
The short interest. It's sitting near 20% of the float. That means a huge group of professional investors is placing a very large bet that management is going to fail to hit those aggressive second half targets. The market is pricing in failure.
So for you listening, what are the, 3 specific things to watch over the next couple of quarters to see if they can turn this story around?
Okay, first, you need hard data. Evidence that LoveBiome cross-selling is actually reviving active account growth. Are they selling the new Healthy Edge stack? Second, look for those synergistic studies on the P84 Pro Tandem combo they promised. And finally, the January weight loss season.
That's the big one.
It's crucial. If the MindBody system doesn't catch that demand spike, the second half guidance is immediately in jeopardy.
We've really set up the binary risk here. So before we wrap, let's do our traditional closing segment. Let's imagine what a very savvy and very risk-tolerant analyst might be thinking.
And we have to say it. This is not financial advice. This is purely a hypothetical exercise based on the high-risk, high-reward setup we've just discussed.
Right, the pitch, the short squeeze catalyst idea. The thesis is pretty straightforward. LFEN is deeply discounted, it's near its 12-month low, and it's miles below the analyst price target of $30.50.
And as we just said, the stock has a gargantuan short interest, nearly 20%. That's a lot of fuel for a potential fire.
Exactly. Management just told us the complex operational plumbing, the systems integration, is done. It was completed November 1st. So the risk shifts from plumbing to sales.
From IT to execution.
So the theoretical trade here is a long position, specifically to play that massive short interest. The logic is simple. If the company hits even the low end of its second half ramp,
driven by that first full quarter of LoveBiome sales and the January MindBody push,
The revenue acceleration could force those shorts to cover and cover fast.
Right.
A strong Q2 report would be a total nightmare for them.
It would initiate the squeeze.
Absolutely. Even a modest upside surprise, say a 5 to 10% revenue beat in Q2 from early synergies, could trigger a sharp, outsized jump in the share price. A move that could quickly get it back towards its 50-day moving average, maybe that $10 or $12 range. It's a classic short squeeze setup. A binary bet against 20% of the float, all resting on whether management can actually execute in Q2.
High risk, high reward. A truly fascinating setup given where the stock is trading.
And with that, we'll wrap our deep dive into LifeVantage. We unpacked a report that had a nice EPS surprise, but was overshadowed by soft revenue, all while management was pitching a future built on GLP-1 alternatives and gut health.
The market is clearly skeptical. It's pricing LFVN like a struggling direct seller, not a profitable debt-free company. But management insists the risk has moved from integration to execution.
So for you, the ultimate question is this. Has LifeVantage successfully bought itself a brand new growth story with the science of P84 and MindBody? Or will the structural problems of the direct selling model continue to outweigh everything else?
That is the inflection point we'll be watching very, very closely.
Thanks for joining us on this deep dive. We'll catch you on the next call.